Hi, everyone. Thank you all for being here. We've got a great webinar that we're hosting today. I'm joined by one of our friends, Colton Jarisch, who is the creator and managing partner of Flywheel Capital Management. And what Flywheel does is they're a private equity company focused on pre-IPO transactions on secondary markets. So his main focus is portfolio management and investor relations. So Flywheel Capital Management creates funds to give individuals and entities diversified access to private companies likely to have a liquidity event, and that's namely IPOs, within 24 months. So what they do is they go in, they buy shares in companies that they have seen that have raised significant amounts of funding, where their next one might be an IPO, and they use different platforms and strategies in order to buy secondary shares. But before we jump into that, I'm going to share my screen here with our deck that we've put together, and let's do a presentation here. And here we go. So Colton, thank you for being here today.
Yeah, definitely. I mean, you gave a bit about me as well, so thank you for that, and a bit about the company. So if anybody has questions or comments throughout the webinar, please feel free to message them over to Thomas anytime, and we can address them.
Absolutely. Yeah, we will be hosting a Q&A after this. So use the chat feature, type in your questions, whether it's about Flywheel specifically, how you can get into Flywheel, whether, whatever questions you guys have, or investing through Rocket Dollar or anything like that, chat them in, and I'll make sure to run through them. But Colton, to kick us off, do you want to go through any of these disclosures or disclaimers?
Yeah, just I think the big one is that this is not an offer to purchase or sell any securities. We're not going to provide any forward-looking statements. If you do have any questions, please feel free to either email me afterwards or visit our site at flywheelcapitalmanagement.com, and I can send you over our prospectus and anything needed from there.
Thank you. Yeah, fantastic. It's always important to go through these. But Colton, let's talk about the problem. We've got the slide pulled up here. I guess we can talk about it in this slide. What was really the genesis for Flywheel, and why did you and your co-founders decide to start it?
Yeah, so and I've been in finance for a while now in many different seats, and what ultimately led to founding Flywheel was watching the Snowflake IPO. There's a slide about it a little bit later, but just watching this thing go from the private markets to pricing at, say, like $65 a share to begin trading at $165 a share, and really just missing out more than anything. To get these shares, I knew it was going to be a good bet more than anything. And I had called my old boss at Morgan Stanley to try to get an allocation of this IPO. I had called my broker at Interactive Brokers and Fidelity, and I just couldn't get it. So more than anything, I missed out on that Snowflake IPO. And then from there, I built this this business model around circumnavigating these investment banks. And I found a few problems along the way in terms of, one, that was missing out, but also the barrier to entry was really high with investing in private companies, no matter what stage they were at. Either the amount required to invest in these companies, from like $250,000 plus into a single company, or just you might not be able to purchase the shares, period, in terms of how their cap tables regulated, and a few different things. So that's kind of what got me started with building these funds. So yeah.
That's awesome. And just an aside, where did the name Flywheel come from? How did you guys come up with that?
Yeah, so I like to think of it and really compare it to like a spin bike or a Peloton bike. I think everybody, or most people, are familiar with a Peloton Now, a flywheel is the technical name for that disc at the front of that Peloton bike. And if you've ever thrown your leg over either a Peloton bike or just an exercise bike, anyone really, it's really hard to make that first pedal stroke, to take that flywheel from 0 to 1. But every pedal stroke after that, as you're getting it up to speed, is easier and easier. And I compare that to venture capital funding. Much like I know Rocket Dollar recently raised their Series A, and that's awesome. Congratulations. But it's really hard to raise your Series A. And that's like that 0 to 1 motion. But then after that, it gets easier and easier to raise your Series B and Series C, and just more and more energy and more funds are pouring into this investment. More than anything, a lot like that flywheel on that Peloton bike. And that's where I kind of came up with the name, because we focus on late stage when that energy is already not at full bore, but it takes less and less energy to make it go faster and faster, or more and more funding.
And that's interesting. And the flywheel is an interesting concept, but do you think that ease of raising additional rounds later and later means companies stay private longer and longer, and thus a lot of retail investors miss out on that huge growth, because there's so many parties out there willing to invest while these companies are still private? Do you see that a lot?
Oh, exactly. I mean, there's some stats out there from like the average amount of time that companies used to stay private was closer to 7 years. And in 2021, it's inching up towards 14 years now. So definitely, like, companies are staying private for longer. And how I view it is investors are completely missing out, because there's this exponential gain from that these companies are seeing from their Series A, B, C, and D, and from there. But then whenever companies start actually trading on the public market. So yes, to answer your question.
And so you guys came up with a fund, and let's talk about the solution of why you guys are pooling money and diversifying, and why someone would want to invest with you guys through a fund specifically, rather than using some of these platforms that sell private shares to do it themselves. Tell me about y'all's specific solution.
Yeah, so I mean, I am very bullish on what they call the secondary market today, of like the transactions in private companies. I think that that market is going to grow exponentially over the next, call it, 10 years. But right now, I mean, you see it on the slide, there's economies of scale, diversification, and early access. That's where we really thrive. In terms of economies of scale, we break down those cost barriers, but also break down the price per share barriers. As you see it today, like, there's a company, I'm in Austin, Texas. There's a company called Micro Ventures in Austin that specializes in selling secondary transactions to individuals for as low as like a $5,000 price tag. But investors don't really realize that they're buying these companies at like twice as high as the price per share as what the company is worth at its like latest venture capital round. So Flywheel really provides those economies of scale. We're slightly larger, where we can command a better price and do our due diligence on what that price should be and what we're willing to pay with that. And then aside from that, it's diversification. If you're transacting on the secondary market, a lot of the time it's going to have a minimum investment of $100,000, and that's really where I decided to raise this fund in Fund One with it's like I wanted to buy Robinhood. They went public on Thursday, and I wanted to put money into Robinhood, but I wasn't sure if I wanted to put $100,000 into Robinhood, because that was the minimum investment size. I knew I wanted to put $100,000 into the private market, and say like I would put $100,000 into 10 different companies, but not one specifically. So the idea came, was like, okay, what if I get 10 friends with a similar thought process to me, and Each one puts in $100,000, and then we buy 10 different companies, and each person gets $10,000 worth of exposure to 10 different companies. So that's the diversification aspect of it. And lastly, is the early access piece. I don't want to buy shares on the public market because I feel like I'm never going to have more information than the vast majority of the public. And I feel like the majority of gains are made in most cases prior to that IPO.
Right, and especially now, and I'm excited for that slide 7 that you and I talked about earlier, because it really does show that growth curve that occurred for Snowflake specifically in the private markets before IPO, and then if you followed it from IPO to now, it's not done so well once it started trading because that valuation was so high. But one of the things that I want to talk about because it's incredibly interesting the way you guys do it outside of Flywheel. I just want to talk a little bit about in this next slide about your target metrics, how you guys do due diligence on different companies that you all are doing deals with, and what you guys look for specifically. So tell me a little bit about how you guys go from scoping out to making an investment.
Yeah, so we run, I think a lot of people have run different filters in trying to decide what companies to buy. And really what we focus on are unicorns, so $1 billion plus companies, Series E or later in venture rounds, and then back-to-back funding rounds. And what I mean by that is we want a company that has raised a venture round in 2021 and 2020. Or 2020 and 2019. So, and a lot of that has to do with the momentum. If you take it back to the Flywheel tie-in around that Peloton machine, if you've ever gotten a Peloton up to speed and you're going from like 50 cadence RPMs to like 100 RPMs, once it's up to speed, it's hard to get, if you try to like push back on those pedals, it'll almost kick you off because there's just so much momentum there. And if you like tie that into, say, Robinhood, for example, there was a lot of headwinds to that IPO and a lot of pushback. But look at it today. I think last I checked, it was like 20% up based on from yesterday. But you can push back as hard as you want, but it's not going to derail your investment all the way back to, say, zero. So that's what we really try to target is that momentum in these companies. So we think if they're $1 billion plus, they're most likely not going to go bankrupt overnight. And even if they did, we have that diversification aspect of where, like, say at most, we're going to have 10% exposure to a single name. In any of our funds. And then if you look at the Series E or later venture rounds, that's really thinking about it in terms of building that momentum and getting those pedals going faster and faster with these venture rounds. Because I like to think of venture firms as they chase each other a lot of the time. Like it's really hard to raise that Series A, but after you raise that Series A, it's easier to raise that Series B with like 2 venture firms or 3 venture firms. So they tend to follow each other. And the more these venture firms are following each other, the less likely it is that these companies are going to fail outright, but also they're fueling that growth more than anything. And that lends itself to that back-to-back funding as well, is like we want that momentum. We don't buy companies that have like private equity funding. For instance, just because we don't feel most private equity shops that are putting operators on these boards are in it for the right reasons, and they might seek an exit that's different than what we want.
Yeah, and that makes a lot of sense. You guys, and let me ask you a question. Are you guys, when you're looking at these metrics, are you guys industry agnostic? Are you guys looking at specifically technology companies? What's sort of the sweet spot in the industries that you guys look at?
Yeah, so we are industry agnostic. We try to follow macro trends more than anything. If you look at like right now, trends that I'm looking at are AI and machine learning or cryptocurrencies. But also ESG metrics around like environmental responsibility. So we don't specifically target companies in those spaces, but At the same time, I view that the vast majority of companies, regardless of the space that you're in, are going to be a tech company in some form or fashion.
Right. I would agree with you on that one. So this next slide is the one that you and I discussed earlier and that we briefly mentioned. But if you would, I'd like for you to walk us through the different funding rounds mentioned in this slide and why it's so beneficial to get in before IPO. Because I mean, this graph looks, I mean, it's ridiculous, right? But walk us through some of these different rounds and what happened from that H to IPO and you know, a lot of people, including, I mean, I bought a couple shares of Snowflake right at IPO and I did terribly.
Yeah.
So so walk us through this slide a little bit.
Yeah. So if you look at the bottom axis there, you see that the years are listed in like 2012 through 2020. And then the other axis is the share price. With say Snowflake, its inception was I think well, they raised their Series A in 2012. Prior to that, they raised a seed round or an angel round, and maybe like came into existence around 2010. But they didn't really start raising money until 2012 with that Series A, as that kind of delineation within the parentheses. And then you can see that they raise money about every year. From like in 2012, they raised their A, 2013 B, 2017, they were raising their F, 2019, they were raising their H, and you can see it really starts to look like a hockey stick. I mean, anything up and to the right is good in terms of an investment, but you can see that their value in terms of their share price or enterprise value is growing exponentially, especially after their Series E is when it really starts to pick up. So from 2016 into 2020, they IPO'd at in I think September 2020. So if you look at their share price prior to that, their last round was about $38 a share, and that's their Series H in 2019. And then from there, the path from like their last venture round to an IPO and involves an offering price and an opening price. The offering price is what investment banks shop to their most valuable clients. So their VIP clients, say you have $10 million plus with Morgan Stanley, you might have access to hot IPOs that are hitting the market. So they'll offer it to you. I think Snowflake, if I remember correctly, it was offered around $167 a share compared to their last VC round, which was $38.77 a share. So that it was offered at that. So these VIP clients can buy these shares at $167 a share. And then whenever it actually starts trading, there's a gap there. On average in 2021, on average, that gap where that IPO spike on day one, that's the gap from the offering price to the opening price. So Snowflake begins trading at like technically it says $167 a share, but it instantly starts trading at $260 a share. So that's when everyday investors, average Joes, anybody can buy it at the public market at that time. So the vast majority of gains are already made. And from there, like you said, you got burned more than anything. Snowflake went all the way up to $400 plus per share. And then you look at their first earnings releases, their second earnings releases, and when these lockups start to expire, and then it just tanks, which I can speak to that later on. But I mean, what did I explain that pretty effectively, or did you have any more questions around that slide?
Yeah, no, I think it makes a lot of sense. And one of the things that's fascinating to me even is that, you know, you mentioned when Morgan Stanley or one of these big banks offers you know, pre-IPO shares to their most wealthy, exclusive, high net worth clients, it's still at a huge premium from the last funding round pre-IPO. I mean, they've essentially missed out on most of the upside, even though they're the most valued clients, right? Which is shocking. And yeah, I remember this specific IPO was crazy, just the volatility and yeah, by the time anything was offered to you know, retail investors like you and me, well, more like me, not you, the upside was gone, and it was a lot more difficult to make money. So Yeah, definitely with the combination of companies staying private longer and a lot of that upside being squeezed out pre-IPO. It's I mean, I think this is why you guys have been so successful so far and will continue to be. Um, Now, one of the things that I'm curious about, and it's on the next slide, and I want to hear more about it, is obviously buying shares in the public markets is easy. You log into your brokerage of choice, buy, sell. We've been doing it forever. Talk to me about some of the different vehicles that you guys invest through, because it's not so straightforward to go buy these shares. I mean, there's a lot of work that goes into it. So tell me a little bit about how that process goes once you guys decide that you're going to move forward with a particular investment.
Yeah, and I think a lot of that might clear some questions up on who we're actually buying these shares from. So a lot of the time we're buying these shares either from employees at these companies that say, like, an employee of whatever Robinhood 2 months ago wanted to buy a house, but all of their net worth was tied up in these restricted Robinhood shares. They couldn't sell them because Robinhood hadn't gone public yet. Or like an early investor in terms of like maybe it's a fund, maybe it's an individual, something like that. But a lot of the time we're literally buying these shares from these employees at these companies, and that's what you call a direct transfer. It's person to person. So we normally transact through a broker in case like the deal goes south, something like that. They can manage the money transfers and different things like that. So a direct transfer is one of the I guess the most common type of transaction that we conduct. An SPV, or a special purpose vehicle, is another one that we invest through. A special purpose vehicle is a lot like what we do in terms of like pooling investor money, but they'll raise, say, like $1 million or $5 million, and they'll go to this to a very specific company, and it'll be a single holding SPV. So they'll buy $5 million worth of one company, and we have a share of that. And there's some insurances involved in that. Sometimes a lot of SPVs have fees or carries that they assign themselves. We never invest in an SPV that does have any sort of fee, because we don't think that's the right thing to do in terms of what benefits our investors. Third option would be a forward contract, which is really, it is scary and gray area. We do not transact through forward contracts. It's really, say like an employee has options at a company that's private, and I sign up, and whenever he can exercise those options, he will give them directly to me. And that's just, it's scary in terms of maybe that employee gets divorced and his wife or her husband has access to those shares prior to me. So there's just a little bit too much gray area for us. And then lastly, a term that comes up regularly in the secondary market is right of first refusal, or ROFR. So if we conduct a direct transfer with a person, we literally have to get the CFO of that company to bless the transaction. So say I want to buy shares of Chime at $100 a share, and the seller agrees to it. That transaction will go to the CFO, and that CFO could say, no, like I would rather buy those shares at $100 and put them back into my company's treasury, or yes, like I am happy to like send these shares off, and then they're ours.
Awesome. And a question that I've had is, whenever you guys make an investment and that company IPOs, as several have done, and I want to ask you about some of the successes you guys have had so far, but how long do you guys typically hold the shares after IPO? Is there a certain lockup period because you bought them pre-IPO? Talk to me a little bit about how that works.
Yeah, so fantastic question. So a lot of that depends on how the company goes public. Right now, I mean, a lot of attention is on SPAC transactions, or like special purpose acquisition companies. So a company could go public either via traditional IPO, the one we're most familiar with, a SPAC, or they can go public via a direct listing. And each of those have different constraints in terms of a lockup. We forecast a 6-month lockup in every transaction that we make. And what we do to mitigate risk there is we hedge a position after it goes public. And we use that using an option strategy called a collar. So we, I can't go into detail, but we basically we lock in our the price at which we're going to sell it at, and we mitigate both our downside and our upside potential in there. And that's built off of how we built the thesis more than anything. We researched every IPO back to the year 2000. And on average, a company in the 12 months following it goes public or it going public, it will realize a 20% increase in value. But 19% of that 20%, or like 94%, is all made on day one. So we feel that the vast majority of the gains on average are made on the first trading day that a company goes public. So we lock in our gains there. We mitigate the downside that comes out of like mitigating our upside potential as well. But according to the thesis, our gains are already made.
Got it. That makes a lot of sense. And I guess we touched a little bit on that. The slide talks a little bit about that. What is your typical? Yeah, I mean, what is your time horizon when an investor comes to you guys and invests one of your funds? What's your typical, or what's your goal for returning that fund and then maybe raising an additional fund, and then what have you guys raised so far, and who are your investors? Are they individuals, companies, etc.?
Yeah, so, and I think somebody posted something in the chat about having an audio problem. I don't know if he's the only one having an audio problem or more people.
Let me check. Let me stop my share real quick and go check on the chat.
Is anyone else having issues with the audio? Nope. All right.
No problems. Okay.
Sounds like
if anybody is having audio problems, we will. I'm recording this and we'll send this out to everybody to be listened to again. But thanks for letting us know. I'm going to go back into it here. All right, and then we're going to go back into here. All right. Yeah. Let's. Sorry, Colton.
Yeah. So big things are like what really separates Flywheel, or what makes us different, and ultimately what that time horizon is. So based off of like how we look at these companies and how we decide what to invest in, we think that there is a high chance that most of the companies that we invest in are going to go public within 2 years, is our time horizon. So we think that there will be some liquidity event within there that, I mean, if you look at that time horizon compared to these venture capital firms who are investing on a 7-year time horizon or a 14-year time horizon, sure, their overall returns could be higher than ours, but that time weighted rate of return, or like an IRR, is going to be comparable or lower than Flywheel's, just because in the grand scheme of things, we're targeting a very short time horizon. Also, there are a few different firms that target late stage pre-IPO companies. I haven't found one that hedges after a company goes public, which I think that really separates us. And lastly, we return capital as we exit positions. So which really lends itself to the benefits of investing through an IRA. So say we invested, DoorDash was one of our first investments. We exited that position in May of 2021, and we would have realized short-term capital gains. We do not target short-term versus long-term capital gains. The vast majority of our investments should hit long-term capital gains just because of like that 6-month lockup and how we invest. But we return capital to investors after each liquidation, and then we're constantly building these new funds. that they can either opt to invest back into, like through a Rocket Dollar account, or they can opt to sit on the sidelines and maybe take their IRA dollars and invest them in real estate or something like that. So it's that flexibility.
Yeah, and that short-term capital gains bit that you mentioned is really why a fund like Flywheel is so powerful through an IRA, through a retirement account, because of that, the tax treatment. I mean, quite simply, other than, you know, as Rocket Dollar, right? We have to plug our own products, but that's really why. You know, you can obviously make these investments with cash or a retirement account, and that's really why we're here. And that'll be my only Rocket Dollar plug. But Colton, on our next slide, we have a little bit about you, and you have their 5 Flywheel exits. Tell me about what those were, and you know, maybe we mentioned DoorDash, but what were some of your other recent successes?
Yeah, and just to continue on the Rocket Dollar plug, man, I almost half of our investors so far have come in or invested through Rocket Dollar accounts, and that's really when the light bulb went off for us of like these. I mean, I'm sure everybody on this webinar has a Rocket Dollar account, but that freed up so much liquidity for investors to come into Flywheel, but also as we started returning that capital contribution and giving the option to roll it into our next fund, that's when it really started to make sense, and people just it opened the doors for a ton of different investors. So we've been really happy with that relationship so far. In terms of what the exits were that we've had so far, we started out with DoorDash was our first exit, and we built our first fund really trying to prove this thesis more than anything. And it was a fantastic time to invest. I think just as the pandemic was starting to wane, and we don't target a specific time, but DoorDash really fit our thesis more than anything. And then we had a few follow right after that in terms of Marqeta was one, Coursera was another. Robinhood went public just last week, and we're hedging it this week as options become available. And we have, I think, 3 more coming down the pipeline in terms of Q3 2021.
That's fantastic. And are you guys actively raising capital today?
We are, and I think because of just regulatory stipulations, I can't speak too much to it. But if you are interested, my email's on the email. There it is, right there. Feel free to send me an email. We have a website, flywheelcapitalmanagement.com, that'll provide some more insight into kind of what we've invested in so far and what we're targeting. But yeah, please hit me up.
Yeah, absolutely, and that's really the goal of this webinar, is to provide enough information that should anybody listening be curious about learning more about Flywheel, please do reach out to Flywheel, because then they can go into details about, you know, they can kind of open the kimono and talk about their entire fund. But Colton, thank you so much. I'm going to open it up to questions here. We got a few minutes left. So if anybody has any questions for either Colton or for myself, please just type them into the chat, and we'll hang out. We've got time, and we'd love to answer your questions. Give everybody a few minutes to type in.
Yeah, I think some of the normal questions that we get are either around our hedging process, how we obtain these shares, which I went through a little earlier, as well. And we transact through really 3 different companies if we don't transact directly with the customers, but we're transacting through brokers like Forge Global, Shares Post, Equities In, and a few private placements as well. We do have a question. I'll read it. Do you find that the options premiums are decently cheap when you're going out to hedge the positions? This really, this backs up the option strategy that we employ. So we really seek to deploy a zero cost collar. So what that is we sell a share, or we sell a contract above the strike price. So say Robinhood goes public, call it at $100 a share. We'll sell a contract of when we think our lockup will expire, call it 6 months out from that day. We'll sell a contract at 105 per share, and then we'll buy a put at $95 a share. So we're locked into this price between $105 and $95 a share. And as we sell that call, it will pay for the put and pay for our downside protection. So yes, we do mitigate our upside, but we also mitigate our downside.
So thank you for that question. That was a good one. Let's see if any other questions are coming in. And yeah, I will follow up with everybody that's attending and everybody that registered that didn't make it with a recording of this video, and included will be the slides, okay, here's another one that came in through the Q&A. How do I, the investor, see the ongoing performance of the fund throughout the approximate 2-year period?
Yeah, so we work with a fund administrator called Socium, and you can see your ongoing performance. We readjust on a quarterly basis, so we'll send out quarterly statements from there, but you can always go into that portal and see kind of how you're performing, what we're invested in. You could see anything down to the options position that we have outstanding.
Fantastic. And then we have got another one here that you can tell me if you can answer or not, but what is your typical minimum investment?
Yeah, we target $50,000 for a minimum investment, and then we can take anything. I mean, like from an IRA investment or a self-directed IRA to cash. We've taken LLCs and a few other things.
Fantastic. Let's see here. I've got 2 windows pulled up. Anne's got another question. How many deals per year do you expect to do once you have enough capital raised?
Yeah, so we deploy capital as we raise it. So we're raising our second fund right now. We've already invested in about 8 different positions. We typically target 10 to 12 positions per fund. And there's, I'll go into the reason why that is like 10 to 12. But to answer your question, yeah, 10 to 12 with that. And why is based around portfolio theory. So say a perfectly diverse portfolio, you need 33 plus holdings, or like a perfectly diverse is like 100 plus holdings in there. You can get 96% of the benefits of that perfectly diverse portfolio with 33 different holdings. You can get 90% of the benefits of that perfectly diverse portfolio through 10 different holdings. So we target 10 holdings, and it's really that targeted diversification more than anything. So you can, as an investor, you can get access to 10 to 12 different companies while raising your barrier to entry to each of those as well.
Awesome. Thank you. And I don't see any more questions coming in. We'll hang out for oh, here we go. Here's another one. Can you explain the details of your fee structure?
Yes, we might have to take this out after the live, depending on regulations, but we start with a 2 and 20 fee structure. So it's a 2% of assets under management, and then 20% of profits, and the profits are really the key there. And it really is something that separates us apart from different either private equity funds or hedge funds, in that we don't take that 20% carry until we pay back all of your original investments. So if you invest $100,000 into our next fund, until we pay you back that $100,000, we really don't make any money.
Awesome. Yeah, and Colton, let me know if you need me to edit that out later on. When does a particular fund close to new investors?
It's typically when we meet our investment minimums. So we started, as we were proving out this thesis, we started with $1 million investment minimum. We ended up 50% above that at 1.5. So we're currently raising a second fund. As I mentioned, if you're interested in it, we're most likely closing that one in mid-August, as we're about 85% funded on that one. And a lot of the time we get a question or a recurring question that we get is, why do you target lower investments, like total size of fund? So we typically, we target, say, like $1.5 million or up to $5 million in terms of total fund size. And that's where we really feel is a sweet spot in terms of inventory available, because there's not always inventory of shares available of the companies that we want. And then if you think about the number of people or the number of employees that, say, have $300,000 worth of a private company that they want to sell versus like that subset of individuals, there's going to be a lot more of those versus one that holds, say, $5 or $10 million worth of the same company. So we feel that we're in the sweet spot of inventory availability and the right size companies right now.
Makes sense. Hold on for another couple minutes to see if there's any questions, but as more come in, Colton, thank you so much for your time today. This was super informative, and for preparing the deck. I think that well, I hope that everybody that is attending learned a lot, and we'll follow up with you and Flywheel to see if it makes sense for them, whether it's Rockdell or not. You know, we just like sharing what we think are cool investments with our audience. And so I want to thank you again for being here today.
Yeah, and thank you so much, Thomas. I mean, this was a lot of fun. I just thought of something else, that really how our investors are investing and why they choose a vehicle like Rocket Dollar is how we return that capital to investors as we exit positions. But we also, if you invest in one fund, you automatically get like a better share class. So someone asked what our fee structure was. We have 3 different share classes that we'll move forward with future funds, and that's A shares, B shares, and C shares. We typically award better class shares to larger investors or returning investors. So if somebody invests in fund 1 or fund 2 with just hitting our minimum, and then they want to come back and reinvest into fund 3, no matter what investment size that they invest with, they'll get our better fee structure, which is like we go all the way down to like 2 and 10%, depending on how you're coming in.
Right, that makes sense. And yeah, I mean, from what I've heard so far, I think a lot of people are going to be coming back and with you guys, because I mean, you guys are obviously doing a great job. So I think we'll wrap up here a few minutes early. And again, thank you, Colton, and thanks for everybody that attended. Hope this was informative. If you have any follow-up for Rocket Dollar or for Flywheel, please don't hesitate to reach out. And we'll see you guys on the next one. Thank you.
Yeah, thank you so much, Thomas. Appreciate it. See you.
All right. Bye-bye, everyone.